Concept of audit risk. There are no auditor would purposely give a wrong opinion on the client's financial statement. However, there is still wrong occurrence for whatever reason. The auditor will try to minimize the risk of giving the wrong opinion. Auditors are currently adopting a risk approach. Therefore, the knowledge of audit risk model is important. Audit risk definition. The risk in auditing means that the auditors accept some level of uncertainty in performing their audit function. An auditor can reduce the uncertainty to an acceptable level through sufficient planning, supervision and conduct of audit in accordance with approved auditing standards. Acceptable audit risk. This is to measure of how willing the auditor is to accept that the financial statement may be materially misstated after the audit is completed and an unqualified opinion had been issued. Factors that may cause uncertainty are nature of audit test, inherent limitation of the client's effectiveness of internal control, and the last one is the audit conclusion is based on audit evidence that is persuasive rather than conclusive. Audit risk model. Help auditor in deciding how much detection risk is acceptable. Materiality. Definition of materiality. The information is considered material when the misstatement could influence the economic decisions. Concepts of materiality. The accountant and auditor used materiality to distinguish between important and unimportant matters. If any material misstatement occur, the matter should be brought up to the client's attention to take action on. It is a relative concept rather than absolute. As materiality is relative, bases are needed to evaluate whether misstatements are material or not. Quantitative guideline. There are no official guidelines on quantitative guidelines of material. Qualitative factors can also affect materiality, as some misstatements are also important although it is only related to a small amount of money. For example, amount involving fraud. Any bad consequences arising from contractual obligation. Misstatement may be material if a trend in earning is affected. Control risk. A material misstatement that could occur and would not be prevented or detected and are not corrected by the entity's internal control structure on a timely basis. Control risk can be considered at two levels. First is the general level. Auditors should consider the management attitude towards the importance of control system by ensuring the company has established internal audit department and risk management department. The second one is specific level. The auditor should evaluate whether the existing control procedures is sufficient to prevent and detect errors. Inherent risk. This is related to the characteristic of the business. The risk exists within the organization that may cause financial misstatement. Inherent risk can be considered at two levels. The first one is at the financial statement or entity level. There are nature of the client's business and number of location of the company, unusual pressure on management such as tight reporting deadline, and the last one is factors affecting the industry such as any critical issue faced in the industry. The second level is at the account balance and transaction level. This is related to the result of previous audit. Any misstatement found in previous audit may occur again due to some companies are too slow in making changes. Other factors is related parties. Misstatement may exist in related parties transaction when both parties are not independent parties. Non-routine transaction. When client are recording unfamiliar transaction, it will be more likely to be incorrectly recorded. Detection risk. This is where an auditor's substantive procedures will not detect any misstatement that occur. Detection risk are the only risk that the auditor can directly control. After assessing inherent risk and control risk, the auditors would be able to decide what level of detection risk will bring the audit risk to an acceptable low level. Then, the auditor would consider the substantive procedure's nature, the substantive procedure timing, the substantive procedure extent, the appropriate direction, supervision and planning during the audit work. Audit procedures that need to be carried out are the substantive test and analytical review procedures.
1. Relationship of audit risk and audit evidence. Detection. Audit risk and audit evidence have an inverse relationship. It means the lower the audit evidence, the higher the audit risk. However, inherent risk and control risk have direct relationship with the audit evidence. It means, the lower the inherent risk and control risk, the lesser the audit evidence needed. 2. Relationship of materiality and audit risk. Materiality and audit risk has an inverse relationship. The level of materiality will affect the level of audit risk. The higher the materiality level, the lower the audit risk and vice versa. In determining the nature, timing and audit procedure, auditor must take into the account this inverse relationship. The auditor may reduce the assessed risk of material misstatement by doing additional test of control or reduce detection risk by changing the nature, timing and planned procedure. For example, when the auditor reduced the materiality from Rm 1 million to Rm 100,000 but using the same level of audit evidence, the audit risk will increase. Therefore, an auditor have to obtain additional audit evidence on the misstatement in order to maintain the audit risk. Now we move on to quantitative level and basis that can be used for valuing materiality. 1. Quantitative guidance on overall materiality. Auditor have to consider about 1. Who are the major users of the financial report? 2. What information is important to their economic decision-making? 3. What qualitative factors might impact the user's financial reporting? First basis is benchmark. The following table should be used to help determine appropriate parameters when calculating the benchmark percentages and weighting factors. For example, for revenue, materiality is considered as low if it is 2%, medium if 1.5% and high for 0.5%. Second basis is weighting factor. Let's look on to the revenue section. Weighting factor for revenue is 50% for profit, 50% for non-profit and 50% for council. Whereas, for total assets, 50% for non-profit while none for profit and council. Third basis is average. In measuring the materiality, an auditor should choose 2 or 3 prior years. This is to avoid the benchmark is being influenced by unusual result in the revenue. On the other hand, to measure the overall performance materiality, we use a sliding scale of percent based upon an estimate of the engagement risk associated with the client. For engagement risk, 90% is at low level, 80% at medium level and 70% is at high level.
Factors influencing determination of materiality. Amount involving fraud. Considered more important than error because frauds will reflect honesty and reliability of the personnel involved. For example, misstatement of inventory amount. If the misstatement due to fraud is more serious than the misstatement due to error. Bad consequences arising from contractual obligations. Small amount of misstatement could be material. For example, in granting loan to the company, the bank for example required the company to maintain sufficient net working capital. So if the net working capital were less than the required minimum even though in small amount, any misstatement could be material because this may put the loan in default. Affect a trend in earning. Misstatements that are immaterial may be material. For example, for the past 5 years, earning increased 5% per annum but income for this year declined by 1%. Any misstatement may be material to maintain the trend. Comply disclosure requirement. Misstatements that are immaterial but still need to disclose. Application of audit risk model to audit work. The audit risk model provides the foundation for auditor performs procedures to assess the risk of material misstatement and design further procedures to respond to the risk. Audit risk or acceptable audit risk equals inherent risk times control risk times detection risk. From formula. Detection risk equals audit risk, inherent risk times control risk. Inherent risk. The risk of material misstatement occur ignoring internal control system. Control risk. The risk that internal controls system will not prevent or detect and correct the error or material misstatement. Detection risk. The risk that the auditor's substantive testing will fail to detect error or material misstatement. Relationship among the component of audit risk. Auditor's assessment of expectation of material misstatement. Ignore internal control. Inherent risk. Payroll and personnel cycle expect few misstatements. Inherent risk, low. Inventory and warehouse cycle expect many misstatements. Inherent risk, high. Auditor's assessment of effectiveness of internal control as prevention measures. Control risk. Payroll and personnel cycle. High effectiveness. Control risk, low. Inventory and warehouse cycle. Low effectiveness. Control risk, high. Auditor's willingness to permit material misstatement to exist. Acceptable audit risk, always low. Payroll and personnel cycle. Low willingness. Acceptable audit risk, low. Inventory and warehouse cycle. Low willingness. Acceptable audit risk, low. Extent evidence the auditors plan to accumulate. Detection risk. Payroll and personnel cycle. Low level. Detection risk, high. Inventory and warehouse cycle. High level. Detection risk, low. The audit risk model. Explanation based on the above table. Once auditors expect few misstatements. Inherent risk, low. In a certain cycle absent of internal control, he or she also expect that internal control system will be highly effective. Control risk, low. To prevent misstatement and therefore he or she will accumulate low level. Detection risk, high. Of audit evidence. Detection risk has direct relationship with audit risk. Detection risk has inverse relationship with inherent risk and control risk. The risk model is to assist the auditor to decide how much detection risk is acceptable. Example for numbers used for the inventory and warehouse cycle. Audit risk is commonly set at 5%, that is, the auditor want to be 95% confident of his opinion. Inherent risk and control risk will be assigned a percentage and detection risk will be the balancing figure. Then these values are used as a guide to determine sample size.
Consideration of analytical review procedures. An auditor can choose from 7 broad categories of evidence, in order for them to decide the audit procedure to use during the auditing process. They can choose from 1. Physical examination. 2. Confirmation. 3. Documentation. 4. Analytical procedure. 5. Inquiries of the client. 6. Re-performance. 7. Observation. Today, we will learn about analytical procedure. 1. What is analytical procedure? 2. What are the purposes of analytical procedure? 3. What are the types? 4. When analytical procedure being used during auditing. Based on ISA 520, analytical procedures can be defined as the analysis of significant ratios and trends, including resulting investigation of fluctuation and relationship that are inconsistent with other relevant information or which deviates from predicted amount. Can also be concluded that this is so important as it is required during the planning and completion phases on all audits. In order for us to understand easily, analytical procedure is when an auditor uses comparison and relationship to assess whether account balances or other data appear reasonable. In other words, auditor perform overall review of financial statements compared to previous year. Now, let's try to think about it. An auditor compare and analyze the differences of current or unaudited financial statement with prior or audited financial statement. For instance, a difference of the company's expenses during and the previous year, resulting a huge difference which exceeds the performance materiality, PM, set by the auditor. Therefore, an analytical review should be performed when the situation occurs. All significant differences were identified for follow-up. So, what are the purposes of the analytical procedure? 1. Understand the client's industry and business. 2. Assess the entity's ability to continue as a going concern. 3. Indicate the presence of possible misstatements in the FS. 4. Reduce detailed audit test. Then, what are the types of analytical procedure? 1. Compare client with industry data. 2. Compare client data with similar prior period data, which is commonly practiced. 3. Compare client data with client-determined expected result. 4. Compare client data with auditor-determined expected result. 5. Compare client data with expected result, using non-financial data. Lastly, when analytical procedure being used during auditing. Analytical procedure are required during the planning phase and in the completion phase of an audit. However, it is often being used during the testing phase.
Audit sampling. According to audit evidence under ISA 500, to provide reasonable audit opinion, auditor first should collect sufficient audit evidence. It is not necessary for auditor to check all the audit evidence, as he can use sampling techniques and other approaches to provide audit opinion. Audit sampling. Definition: taking less than 100% items in account balances or class of transactions so that all sampling units have equal chance of selection. This enable auditor to obtain and evaluate audit evidence, also assist auditor to draw audit conclusion. Sampling risk. Definition: conclusion made by auditor based on sample may be vary from conclusion drawn from 100% examination performed. Sampling risk types. There are two types of sampling risk. 1. Test of control risk. 2. Substantive test risk. Test on control risk. Type 1, risk of assessing control risk too high. Auditor conclude that the risk is higher than it is actually is. Type 2, risk of assessing control risk too low. Auditor conclude that the risk is lower than it is actually is. Substantive test risk. Type 1, risk that the auditor conclude that there is a material error, but in fact, it does not exist. Type 2, risk that the auditor conclude that there is no material error exist, but in fact, it does exist. Non-sampling risk. Risk happen that are unrelated due to sampling approach. Examples: evidence misinterpretation, human error. Types of audit sampling. 1. Statistical sampling, also known as probabilistic sampling. 2. Non-statistical sampling, also known as non-probabilistic sampling. Statistical sampling, probabilistic sampling. Approach that have following characteristics. A. Select random sample. B. Use probability theory to evaluate sample results. C. Auditor can use statistical sampling as a representative to a large population. D. Can be used as a defend measure, as it is a systematic approach of selecting sample. There are 3 categories of statistical sampling. A. Attribute sampling. B. Monetary unit sampling. C. Classical variable sampling. Attribute sampling. Used to estimate the proportion of a population that possesses a specified characteristics. Most common use is for test of control. Monetary unit sampling. Uses attribute sampling theory and techniques to estimate the amount of misstatement for a class of transactions or account balances. Classical variable sampling. Uses normal distribution theory to evaluate the characteristics of a population based on sample data, of which data should have equal chance of selection. When to use statistical sampling depends on auditor's judgment and sufficiency of audit evidence. Non-statistical sampling. Auditor uses his professional judgment to select sample and evaluate sample when conducting audit test. Why use non-statistical sampling? Because it is less costly as compared to statistical sampling, which require cost for auditors' training. Other than that, it is also less time consuming but can be effective in satisfying audit objectives.